When people think of investing, most imagine excitement, the thrill of spotting the next tech unicorn, cryptocurrency, or a once-in-a-lifetime stock tip. Headlines scream about overnight millionaires, sky-high returns, and the latest market trends. The world of investing is portrayed as flashy, fast, and dangerous, and most people want a piece of that action. But here's the secret Charlie Munger knew decades ago. You don't need excitement to get rich. In fact, chasing excitement is the fastest way to lose money. Munger, Warren Buffett's longtime partner, made billions by doing something that seems almost boring. He followed a simple, disciplined, and predictable strategy. One that avoided hype, speculation, and emotional mistakes. While the world chased the next hot stock, Munger quietly compounded his wealth through what most would call boring investments. Think about it. When you hear someone describe an investment as boring, you might feel skeptical. How can boring make billions? You ask. That's exactly the point. Boring investments avoid the risks that destroy wealth. They grow steadily, predictably, and quietly. Munger didn't need excitement. He needed stability, clarity, and the power of time. This is what makes Munger's approach so fascinating, and why it's still one of the highest probability paths to wealth today. In this video, we're going to break down what Munger means by boring investments, why they work, and how you can apply the same principles in your portfolio. Most investors fail not because they lack intelligence, but because they chase excitement and ignore the risks. Human psychology plays a huge role in investing mistakes. Fear of missing out. FOMO people panic when they see others making quick money. They jump into investments without analyzing the business or understanding the risks. Herd mentality. Investors often buy what everyone else is buying, assuming the crowd knows better. This leads to overpaying for assets and exposure to trends that can collapse. Greed. Chasing high returns can make people take risks they wouldn't normally take. They borrow money, speculate, or invest in businesses they don't understand. History is filled with examples. During the dot-com bubble, many investors rushed into internet startups with no profits, no business models, and sky-high valuations. People got swept up by hype and the excitement of getting rich fast. When the bubble burst, countless fortunes vanished overnight. Contrast this with Munger. He recognized that excitement and risk go hand in hand. The flashiest investments often have the highest probability of failure, while boring, predictable investments grow steadily and reliably. This is why Munger's approach is counterintuitive. In a world obsessed with the next big thing, he intentionally avoided it. He wasn't interested in short-term gains, headlines, or social validation. His goal was long-term wealth preservation and growth, and that often meant choosing investments that looked boring to everyone else. Investors who chase excitement rarely survive the long run. Those who embrace boring investments avoid mistakes, stay in the game, and let compounding quietly build their wealth over decades. What Munger means by boring investment. So, what exactly does boring mean in Charlie Munger's world? A boring investment is understandable. You know the business, how it makes money, and the risks involved. Predictable. Cash flows are stable, and the business isn't likely to collapse overnight. Durable. It has a competitive advantage or moat that protects it from competitors. Managed well. Leadership is competent, ethical, and focused on long-term value. Examples of Munger's boring investments include Coca-Cola, a global brand, consistent cash flows, and simple to understand. See's Candy, a small, predictable business with strong brand loyalty. Insurance companies and utilities. Often low risk, consistent earnings, and easy to analyze. Munger didn't chase fast-growing, unpredictable businesses that could fail. Instead, he focused on companies that might not make headlines but would grow slowly, safely, and predictably over time. Boring doesn't mean unprofitable. On the contrary, boring investments often produce better long-term results because they avoid mistakes, survive market downturns, and allow time to compound returns. Munger's brilliance wasn't in picking flashy winners. It was in avoiding losers and letting the power of compounding work quietly. Even if a boring investment only grows 6 to 8% per year, over decades, the effect is enormous. The combination of stability, predictability, and time is what builds generational wealth. And that's exactly what Munger exploited. Key takeaways from points 1 to 3. Excitement in investing is often a trap. It leads to mistakes and permanent losses. Most investors fail not because they lack intelligence, but because they chase hype, fear missing out, or act emotionally. Boring investments are predictable, understandable, and durable. Exactly the type of investments Munger loved and used to build billions quietly. The role of margin of safety in boring investments. One of the most powerful tools behind Munger's boring investment strategy is the margin of safety. Think of margin of safety like a seatbelt. You hope nothing bad happens, but if something does, it protects you from catastrophic loss. In investing, it means buying high-quality, predictable businesses at reasonable prices so that even if things don't go perfectly, your capital is safe. Why is this so important? Because even the best businesses can face challenges. Market downturns, economic crises, or unexpected events can temporarily reduce the value of a company. Without a margin of safety, these fluctuations can become permanent losses. With a margin of safety, however, the impact is cushioned, and the investment survives, often stronger than before. Munger's approach was simple. He didn't need to pick the perfect timing or predict the next big thing. He looked for businesses with predictable earnings, durable competitive advantages, and competent management. And he bought them at prices that gave him a cushion. This cushion is the margin of safety. For example, Coca-Cola may have seemed expensive at one point, but because it had consistent profits, global brand recognition, and predictable cash flows, Munger knew the risk of permanent loss was minimal. Even if the stock price dropped temporarily, the business itself remained solid, ensuring long-term growth. This is why boring investments work so well. They aren't designed to deliver explosive gains overnight. Instead, they are built to survive crises, withstand volatility, and compound wealth steadily. The margin of safety ensures that these investments are boring in a good way, safe, stable, and predictable. The power of patience and time. Patience is one of the silent heroes behind Munger's boring investment strategy. Most investors want instant results, checking their portfolios daily and chasing the latest hot stock. Munger, however, knew that time is an investor's best friend, especially when combined with boring, high-quality investments. When you invest in a predictable business with a margin of safety, you don't need to act frequently. You don't need to sell every time the market dips or buy every opportunity you hear about. Instead, you hold for years, sometimes decades, allowing compounding to quietly multiply your wealth. Consider See's Candy, one of Munger's favorite examples. It's a simple, small business with steady profits and loyal customers. There's nothing flashy about it, no headlines, no hype. But over decades, this small business contributed massively to Munger and Buffett's wealth simply because they held it patiently and let the returns compound year after year. Patience also reduces mistakes. Impulsive actions often lead to permanent losses. By waiting for opportunities where the risk is minimal and the fundamentals are strong, you reduce the likelihood of errors. Munger once said that inactivity is a skill. Doing nothing, when done correctly, can be more profitable than constant action driven by greed or fear. The boring strategy works because it leverages time instead of excitement. While everyone else chases quick wins and fails, Munger's patience allows his investments to grow steadily, quietly, and reliably. A powerful advantage over the long term. The psychology behind boring investments. There's a psychological advantage to boring investments that Munger understood better than most investors. Investing is as much about mindset as it is about numbers. Boring investments reduce emotional stress. You don't have to panic when a stock drops 10% or 20% because the fundamentals remain solid. You aren't swept up in market hype because your strategy is grounded in logic, analysis, and predictability. This mental clarity prevents emotional mistakes, which are one of the leading causes of permanent loss. The psychology of boring investments also counters the herd mentality. Most people buy when everyone else is buying and sell when panic spreads. Munger did the opposite. He ignored crowd psychology and focused on the intrinsic value of businesses. This allowed him to avoid the mistakes that ruin most investors. Boring investments also encourage discipline. You stick to businesses you understand, buy at reasonable prices, and hold for long periods. This structure creates consistency, reduces impulsive decisions, and builds confidence. All crucial psychological benefits for long-term investing success. Finally, boring investments simplify decision-making. You don't need to track dozens of volatile stocks or try to predict the next market trend. You focus on a few high-quality holdings, which reduces stress and allows better mental focus. The result: fewer mistakes, less anxiety, and more reliable wealth growth. Munger's genius lies in combining the psychology with his disciplined strategy. By loving the boring, he eliminated stress, emotional errors, and unnecessary risk, all of which are major obstacles for most investors. Key takeaways from points 4 to 6. Margin of safety protects against mistakes and ensures stability. Patience and time allow compounding to work quietly, producing extraordinary long-term returns. Psychology matters. Boring investments reduce stress, prevent emotional mistakes, and keep you disciplined. These principles show why Munger's boring investment strategy works so well. It's not flashy or exciting, but it's high probability, reliable, and built for long-term wealth. Keycap 7 real-world examples of Munger's boring investment wins. Charlie Munger didn't just talk about boring investments. He built his fortune practicing them. Let's look at a few examples that show exactly how this strategy works in the real world. Coca-Cola. Coca-Cola is perhaps the most famous example of Munger's boring investment philosophy. At first glance, it's just a soft drink company. Nothing flashy, no cutting-edge technology, no huge hype. But that's exactly why it fits Munger's strategy. Why Coca-Cola was a perfect boring investment. Understandable business model. People drink soda. Revenue comes from sales. Simple. Durable competitive advantage. Iconic brand and global distribution network make it hard for competitors to take market share. Predictable profits. Cash flows are steady, even during economic downturns. Competent management. The leadership team focused on efficiency, brand growth, and long-term profitability. Munger and Buffett bought Coca-Cola stock in the late 1980s and held it for decades. It didn't make headlines every day, but over time, it produced massive, consistent returns, perfectly illustrating the power of boring, high-quality investments. See's Candy. See's Candy is another prime example. A small candy business may not seem like an exciting investment, but Munger loved it because of its simplicity and predictability. Key points. Consistent profits. Customers loved the candy, and sales remained steady year after year. Loyal customer base. The brand created repeat buyers, ensuring predictable revenue. Simple operations. Easy to understand and manage. No complex technology or volatile market trends. While See's Candy didn't make headlines or create hype, it contributed tens of millions to Berkshire Hathaway's wealth over decades, purely through compounding predictable profits. Berkshire Hathaway Holdings. Even Berkshire Hathaway itself reflects Munger's boring strategy. Most of its investments are in stable, predictable companies, such as insurance firms, utilities, and consumer brands. For example, insurance companies. Steady cash flow and predictable risk models. Utilities. Low volatility and consistent demand. Consumer brands. Simple businesses people rely on daily. By sticking to these predictable, boring businesses, Munger and Buffett avoided unnecessary risk while steadily growing their empire over decades. The lesson is clear. You don't need excitement to build wealth. Sometimes stability and simplicity are more profitable than hype and risk. Why this strategy works better than speculation. Many investors believe that to get rich, you need to speculate, to chase trends, pick the next tech unicorn, or invest in volatile markets. History proves otherwise. Speculation is risky, stressful, and often leads to permanent losses. Munger's boring strategy works better for several reasons. Consistency beats brilliance. You don't need to be a genius to make money. By consistently investing in predictable, high-quality businesses, your wealth grows steadily. Compounding over decades produces results that speculative, high-risk trades rarely match. Reduced risk of permanent loss. Speculative investments can fail overnight. Boring investments with strong fundamentals and a margin of safety minimize the risk of permanent capital destruction. Emotional stability. Speculators react emotionally to market swings, leading to panic selling or chasing losses. Munger's boring approach reduces stress and emotional mistakes, allowing you to stay calm and rational. Leverages time, not luck. Speculators often rely on timing or luck to win. Munger relies on time and compounding, a far more reliable path to wealth. Focus on quality over quantity. Instead of owning dozens of volatile stocks, Munger focuses on a few high-quality businesses. This reduces errors, makes analysis easier, and maximizes the impact of each investment. The boring strategy is not glamorous, but it survives market downturns, avoids catastrophic losses, and lets wealth compound quietly over decades, the exact opposite of speculation. How average investors can apply this strategy today. Now, how can you apply Charlie Munger's boring investment strategy in your own portfolio? Here's a practical guide. 1. Stick to businesses you understand. Don't invest in things you don't understand. If you can't explain how a business makes money or what drives its profits, skip it. This reduces the chance of permanent loss. 2. Focus on quality. Look for businesses with strong brand recognition, durable competitive advantages, consistent profits, competent management. These characteristics make the business boring but reliable. 3. Buy with a margin of safety. Even a high-quality business can underperform temporarily. Buying at a reasonable price ensures that you protect your capital and reduce risk. 4. Be patient. Boring investments reward long-term holding. Don't expect instant gains. Let compounding quietly multiply your wealth over years or decades. 5. Avoid speculation and hype. Ignore trends, tips, and hot stocks. They may be exciting, but they're often high risk and unpredictable. 6. Keep your portfolio simple. A concentrated portfolio of a few boring high-quality businesses is easier to manage and less risky than a complicated portfolio of dozens of volatile stocks. 7. Stay disciplined. Avoid emotional decisions, panic selling, or chasing gains. Stick to your boring high-quality investments and follow the principles consistently. By following these steps, you apply Munger's strategy today. Steady, predictable, and profitable over the long term, without the stress, hype, or risk of speculative investing. Key takeaways from points 7 to 9. Real-world boring investments like Coca-Cola, See's Candy, and Berkshire Hathaway Holdings compounded wealth quietly over decades. Boring strategies reduce the risk of permanent loss, avoid emotional mistakes, and leverage time instead of luck. Average investors can implement this by focusing on quality, margin of safety, patience, and simplicity. How to apply Munger's boring investment strategy today. Charlie Munger's approach may seem simple. Invest in predictable, boring businesses, but applying it consistently takes discipline. Here's a step-by-step guide you can use to implement his strategy in your own portfolio. 1. Focus on understandable businesses. The first rule of Munger's strategy is to stay within your circle of competence. Don't invest in things you can't fully understand. If the business model is too complex or the risks are unclear, skip it. Example: instead of chasing crypto or volatile tech startups, look for companies with simple, predictable revenue models, like consumer staples, insurance, or well-known brands. Why it works. Understanding the business reduces risk and helps you avoid permanent capital loss. 2. Look for quality, not excitement. Boring doesn't mean bad. It means stable, predictable, and durable. Focus on businesses that have strong brands with customer loyalty, durable competitive advantages, moats, consistent cash flows and profitability, competent ethical management. These are the types of businesses that Munger loved. They might not make headlines, but over decades, they create massive wealth through compounding. 3. Buy with a margin of safety. Even high-quality businesses can face challenges. Buying at a reasonable price ensures your capital is protected, even if things go slightly wrong. Example: Coca-Cola may have been expensive at one point, but its predictable profits and global brand made it a safe, boring investment. Margin of safety cushions your investment against market fluctuations, mistakes, and unexpected risks. 4. Be patient and let time work. Munger's strategy relies on long-term holding. Patience allows compounding to work quietly. Don't expect overnight riches. Resist the temptation to chase trends or check daily stock prices. Focus on long-term growth and stability. The beauty of boring investments is that time amplifies their value. The longer you hold, the greater the effect of compounding, quietly and powerfully. 5. Avoid speculation and hype. The world is full of hot tips and hype-driven investments. Munger ignored these because speculation is risky, stressful, and unpredictable. Tip: ignore social media trends, celebrity endorsements, and short-term market noise. Instead, stick to quality businesses that grow steadily. 6. Keep your portfolio simple. Munger doesn't overcomplicate things. A small number of high-quality investments is easier to manage, reduces risk, and maximizes the impact of each investment. Example: instead of owning dozens of speculative stocks, focus on a few strong companies with durable competitive advantages. This makes analysis easier and decisions clearer. 7. Stay disciplined and rational. Boring investing requires mental discipline. Avoid emotional decisions like panic selling, chasing trends, or reacting to market volatility. Consistency is key. Stick to your strategy, follow the principles, and trust the process. Munger's success wasn't about brilliance. It was about avoiding mistakes and staying disciplined for decades. 8. Learn from history. Finally, study past market crashes, investment mistakes, and successes. Understanding what went wrong and why helps you avoid common pitfalls. Example: the dot-com bubble and 2008 financial crisis taught the importance of investing in stable, predictable businesses. Knowledge reduces mistakes and reinforces the boring but safe strategy. Charlie Munger's boring investment strategy is deceptively simple, but that's what makes it powerful. He didn't chase excitement, trends, or overnight success. He focused on predictable, understandable businesses, durable, competitive advantages, margin of safety, patience and long-term holding, discipline and rational thinking. This approach is boring but reliable. It minimizes risk, avoids emotional mistakes, and lets time do the heavy lifting through compounding. While others chase hype and volatility, Munger quietly builds generational wealth. The lesson for every investor is clear. You don't need flashy stocks, crypto, or hot tips to succeed. Boring works, and over decades, it can create results that speculation rarely matches. By applying this strategy, you can protect your capital, reduce stress and emotional mistakes, let compounding quietly grow your wealth, build long-term financial security. Charlie Munger didn't just talk about boring investments, he lived them. And that's why, decades later, his wealth stands as a testament to the power of patience, discipline, and simplicity. Follow his strategy, stay disciplined, and embrace the boring. In the long run, it's the most exciting path to financial freedom you'll ever find.